Hey guys, what's going on? Guys, I want to talk to you guys about trading patterns. So what a trading pattern is the basis amongst everything that you do in technical analysis. So fundamental analysis is the analyzation of a company's fundamentals, from how much money they make to who the CEO is to what type of products they have, so on and so forth. Now the thing with fundamental analysis is that it is great for something when you're looking 3, 4, 5 years down the road. But what if you're just looking for 1, 2, 3, 4 months down the road? Price moves off supply and demand and momentum and news. And so what we want to do is use the application of chart patterns to find our plays, and that analysis of technicals will help govern what we're supposed to do. Meaning we use technical analysis to govern all our trading decisions, from the entry to the exit to the management of the position, and of course, how much of that position we actually buy. So today I'm going to go over a very simple technique that I think you guys can use every single day and every single week. I have been using this pattern for over 13 years, and I've been using it very successfully. It is a fantastic pattern for bull markets, and I want to teach it to you guys because I think it's one of the easiest patterns to identify. You know, when you're new and all these lights are blinking, things can get very, very confusing. But if you can simplify trading into very, very specific terms and checklists so that you know what you're looking for, and you have a pattern that is easily identifiable, then what you can do is build out a checklist for that particular trading strategy. And then you can actually go and duplicate it over and over and over. So today I want to talk to you guys about a flag pattern. A flag pattern is an awesome trading setup that I think you guys can use on a daily basis, if not a weekly basis. So the biggest part of a flag pattern is, let's first go into the rules of it. So what a flag pattern is a consolidation pattern on a trending name. So what you can see on this particular name here, this is a company called 10. This stock was at $10. It's run all the way to $21. So it's got some momentum in it. Now, what we want to be doing once, we see something that has momentum is finding out ways to get into that trade where our risk is small. So a flag pattern is a momentum trade based on stocks that have moved up a minimum 20% in the last 10 days. And then what we are looking for is a 3 to 10 day consolidation in a tight range for a continuation of that trade. So what I mean by that is, like, this is this trade that I just took recently. This stock in May 3rd was at $10 and ran all up to 15. So that satisfies our 20% over a period of a few days. And then what you can see here is for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, it sat around in a very, very tight range. You can see like the lower end of the range is at 13, kind of the top end of the range is at 14.50. And so what we're starting to do here is build out a consolidation. Stocks get their power from consolidation and basing. What I mean by that is, in like a retail vernacular, we're always looking for something that's cheap, right? But in trading, cheap is usually not good. When a stock is just falling and falling and falling, they tend to fall even further. Trading is about trends and how can we find low risk ways to hop on that trend when it avails itself. So this is a trade that came up on one of my TC2000 scanners, which you guys will all have access to as my students, that showed up and it moved from $10 to $15. So I actually didn't participate in this move, which is totally fine. When a new trend is formed, you have numerous trade opportunities over the next weeks to months to capture additional gains once it starts. So as you can see here on May 10th, this stock topped out at $15.50, and then it's been like the next 10 days just building out a nice flag. See how like it actually looks? This is your flag pole and a flag. So what we're looking for is a 20% mover plus, a 3 to 10 day consolidation. And this blue level over here, that's your 9 EMA. On my charts, I use a 9-day moving average a 20, a 50, and a 200. So what I want is for that 9 EMA to catch up to price and tighten the range to provide support. Once the flag is formed and you get that tight consolidation where the top end of the range, you've tested it multiple times, and that 9-day moving average is snuggled up right up under it, when the range breaks, you're going to put your stop loss right under the 9 EMA. So you've got a very, very low risk trade for a potential big move. So the primary move, if it went from 10 to 15, I can reasonably deduce that the next move will be minimum $5 also, as a trend on this has just started to form. This is a very simple but powerful technique. And the reason is this. What is your risk on this trade? So we're going to buy this stock at $4, $14.18, and our stop loss goes at $13.76. We're risking 50 cents. But our potential gain on this trade is $5. So what happens on a trade like this is if you have 1,000 shares and you lose on the trade, okay, you're going to lose $500. But if you win on the trade, you could make up to $5,000 potentially. Now, of course, that's a perfect storm of things, but sometimes they go even further than that, and that's when you can get a big trade. The big portion of trading that you guys just got to get always inside your heads, it took me a long time to do, is that we need to put ourselves in scenarios where our risk is really low. How can we risk pennies to make dollars? And then when you duplicate that over and over, you have the ability to really have some fun. Because if you lose on a trade here or you lose on a trade there, it's not going to ruin your day. But if you can hit even a couple of these at a 50% win ratio, what's going to happen is when you win, you're going to make a few thousand. When you lose, you're going to lose a few hundred. And now that's something you can duplicate over and over and over. Now you can see on another aspect of this, following the same rules. This is a company called APHA. This was a pot stock company. During this phase in January, a lot of the pot stocks were running based on some legalization news. And same type of deal. So you've got this stock. It's at $7. It runs all the way to $13. So you satisfy the minimum 20% in 10 days. If anything, this has even more momentum, right? It's gone from 6 to 13. That's 100% gain. Now, it's the same parameters, though. I want to see a minimum 3 to 10 days sideways consolidation before I can get this thing going. So now you got this thing pop up. You've got sideways consolidation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days consolidation. Now, it could be 4, it could be 5, but it's usually going to be between 3 and 10. Now, as you can see here, your rising 9-day moving average is starting to curl up under it. Remember what I told you. Stocks get their power from consolidation. They get their power from the tightness of range. That's what creates explosion, but that's also what allows you to minimize your risk. So when the trend line breaks, you're going to be buying this at about $13 and some change. Your stop loss goes under your 9 EMA. So you got a very, very small risk. But now you got a small risk with the opportunity to potentially catch $6, $7. Well, I always use the primary move from the flag as a potential basis of what that stock could move in the future. It's what we would call a measured move. Now you can see here, this is another company called EH. It's the same type of deal. You can see like a stock like this is flag after flag. You get a push, tightness of range, go. Push, tightness of range, go. Push, tightness of range, go. The key on this type of trade, on any kind of consolidation trade, is you want that 9 EMA curling right up under the kitchen on that stock. It'll allow it to provide some support, and now you can do it with a really low risk entry. And you can do this, guys, even on cryptocurrencies. So what I mean is, like, you can go in and take this type of trade on any type of name. So like if you're thinking about, say you're trading like Bitcoin or something like that, like this is BNB coin. This is a coin that I trade quite a bit. You can see it very, very something similar. What do you got over here? See how this thing was at $20, $30, ran all the way to $140. Normally, you would think that's a lot, like, right? That's a huge move, but it doesn't necessarily mean anything. In trading, momentum begets more momentum. And it doesn't matter if you're looking at the stock market, the futures market, it's all the same stuff. Price action, price patterns is the same stuff. So now what do you have here? So you got this push to 160, and then look what happens. 1 day, 2 day, 3 day, 4 day, 5 days, 6 days of tightness. Remember, 3 to 10 days of tightening range. Now you're starting to build out a proper flag here. So as you start to go, you get buy as your trend line breaks. Your stop loss goes under the 9 EMA. Now you got this thing as a go. Remember, this thing just moved about $100. So you can reasonably deduce that the secondary move can be just as powerful. When a trend is formed and you get your first move, the secondary move can often be more powerful than even the primary move. Momentum begets more momentum. And that's something, as long as I know you guys, I will be parting, that information in your heads. I bang it over my students' heads like every single day. Momentum begets more momentum. Now, you can do this same type of trade when you are intraday trading also. It doesn't have to be just something that you use on your daily chart. So like when we're intraday trading, we do very, very similar, setups, but we just do them with 5-minute charts. So like you can take a trade. For example, I was trading this DocuSign the other day, and DocuSign is a $200 stock, but it's the same kind of parameters where you get like a big push, and then you get that sideways consolidation. You buy as you break the range, your stop goes under your 9, and then you take your move. And you'll see that just happen like over and over on so many trades to the upside and downside. This is a tactic that I use day trading, swing trading, cryptocurrencies, futures. It is applicable everywhere. Guys, hopefully that helps. I've got 18 other trading patterns that I use. I think this is a great starting pattern because it's something you can use every day. And it's also easy to identify. Beyond that, I have bounce patterns and pullback patterns. I do swing trading and day trading. I believe, it's good to learn both. Your swing trading, your longer term things is great for wealth generation, your IRAs, things of that nature. And day trading is awesome because it's just you're trading every day for income. You take your money, and you pay yourself. And I think it's important to learn both. There's a huge overlap on them anyways. Like when I'm teaching class, I do 3 days on the swing trading side. I do about 5 days on the day trading side. So 8 days combined on those, before I go into the risk management, the scanning, how to set up all the tools. My boot camp runs about a month of straight classes, 3 days a week. And then we start moving on to other stuff. But the awesome part is like while I'm trading, like my guys, they're watching me trade live. So like I come in, a lot of you guys will come in and probably, have been in our free chat days and stuff. I post a link in the morning and I come in and I show my guys how to trade. So I'm giving them like all my alerts and things like that. And I'm chatting with the guys. All these guys and girls have been trained by me. They're students of mine, which is so awesome. And, we sit together and we trade and we share ideas. But the main thing is I'm on screen share showing people what I'm doing all day. So like while we're spending nights learning about class, while we're spending our nights learning about class, we have the daytime to actually sit there and watch me trade. That's going to give you two things. Number one, it's going to help you identify patterns in real time. But number two, it's going to give you the confidence to know you can go out and do this. When you watch me trade, there are days I lose. There are days, that are just a little bit more rough than others. But I have that consistency. Watching somebody come in and do winners every day, run the process the right way, get out of the trades when they need to. And then, of course, every single day we discuss these trades. We reverse engineer them and we say like, here's what I did right. Here's what I did wrong. And, so all these trades I take, the good, the bad, the ugly, we go into them. Like, why did I take this trade? What was the pattern? How did I find it? And then from there, we start reverse engineering it. What could I have done a little bit better? What could I have done, a little bit faster, slower, whatever it might have been. There's so many mistakes that can be made on a trade. But in the end, it really comes down to price patterns and just managing your risk. And it's a fun time watching, somebody else trade. And of course, my guys, you guys can ask questions and stuff during the trading day. Hey, what do you think about this? What do you think about that? And we go over them since I'm on the computer screen sharing anyways. So guys, use this pattern. It's something simple but powerful. It's something to keep with you for the next 10, 15 years because it's been applicable every day since I started trading, and that was quite a long time ago. Guys, take care. Let me know if you have any questions.